Great. Good day, everybody. Let's get started. My name is Emmett Kilduff, one of the co-founders here at the Fortia Group. Welcome and look forward to digging into our second deep dive on valuations this year. So the agenda today, I just very briefly will give you 2 slides updating what we're at the Fortia Group. We'll then follow our usual scientific approach to thinking about valuations. There's a 7-step approach that we will walk you through. We've got some great speakers to help do that. And hopefully we'll have some time for Q&A. From a housekeeping perspective, please submit questions via the Q&A tab. Kindly do not use the chat. They won't be addressed. It's much easier to chair if it's via the Q&A tab. And as ever, the recordings of all our webinars are available on our YouTube channel. Just stick in the Fortia Group onto youtube.com to see those. The PDF, the link to the recording will be sent out to you all as follow-up in the coming days. So just to remind everyone, the Fortia Group, what we're all about, we are exclusively focused on M&A as a service. We are focused on the lower middle market tier, and all we think about is the e-commerce sector. That's what we've been doing for the last 5 years. That has broadened. Initially, we were brands only, and now we also work with digital agencies. Obviously, there's a strong linkage there. I used to work at Morgan Stanley. That's where they're doing the very big deals. We're trying to bring that level of service, the Wall Street level of service, down to the lower middle market, specifically focused on the e-commerce world. So that's where we're positioned. As some of you hopefully know and have actually attended, every year we host the only Acquire conference specifically for the e-commerce sector. Delighted to give you all a date for 2026. We're moving it from the end of January into March to link up with warmer weathers. So 9th of March, we'll have our full 1-day conference. There'll be maybe a few small events that week in New York as well. If you're an entrepreneur that is actively selling, we will welcome you to pitch to the audience. Think of it as a formal Dragon's Den or Shark Tank. If you're not looking to sell your business today, it's still a great opportunity to come and see how the whole world of M&A in the e-commerce sector works, and to start sort of beginning to think about how you're going to flirt, date, marry to ultimately get to the deal that you want. It's invite only. There's no cost for tickets. If you'd like to come, please scan that QR code to register your interest or reach out to the inquiries at thefortiagroup.com. Okay, so in terms of our latest and greatest thoughts on valuation, we have a super panel for you today. I'd like each of the speakers to give a short introduction to their background. Max, you're up first, please.
Hello, everybody. I'm Max Kaiser. I'm the Director of Data Science at Grips Intelligence. We're an e-commerce intelligence platform focusing on transactional intelligence. And I'm also a researcher focusing on e-commerce research.
Thank you, Max. Austin, are you there?
I'm here. Nice to meet you, everybody. My name is Austin Gardner-Smith. I'm a co-founder and CEO of DrivePoint. We are an FP&A platform for consumer and CPG brands. Excited to share some data that we've been tracking across public and private companies.
Good to have you as always, Austin. Thank you for joining. Joshua?
Hey everybody, pleasure to meet you. Insight and Strategy Director at eComplete, responsible for driving our investment and commercial due diligence processes, very much on the pulse, looking at operational, marketing, performance data across businesses and helping us make our investments.
Very good, Joshua. And please, Paul, are you there?
Yeah. Hi, everyone. So Paul Gedman, I'm coming up as Josh Elliott because I pinched his link. So I am Paul. Yeah, founder of eComplete alongside Andy Duckworth. Got a good history in e-commerce of building and internationalizing D2C brands. eComplete's really about reinventing that private equity model. We say we're 25% private equity M&A, and we are 75% operators. So we really kind of get in the trenches with the acquisitions and the teams when we buy businesses.
Very good. Thank you, Paul. So the way it'll work, I'll talk about global M&A activity, where we're at. Thankfully, there's some positive news flow there. We'll have Max talk about e-commerce trends, the latest trends based on the Grips data. Joshua will talk about public market comps and give insights there, like he always does on these webinars. We'll have Joshua talk about e-commerce M&A activity and brand metrics, and Paul will finish to talk about deal metrics, and he's done some deals in the last few weeks that are really interesting. So that is the melting pot that gives us the data to help us think about what the Fortia Group believes are the typical valuation ranges that assets can trade at today. So we'll give you our latest thoughts to finish. So let's jump in. From a global M&A activity perspective, let's look back over the last 10 years to give us some context. And this is for all sectors, global deals. All sectors hit a high on a last 10-year view in 2021. That was clearly also applied to us on this call in the e-commerce sector, when December 2021 was sort of the highs from a deal volume, deal valuation perspective. It's been tough for all sectors since then. It's sort of been down or treading water. E-commerce as a sector within that has probably been even tougher, as we all know, coming off the highs of COVID and dealing with tariffs in Q2, etc. The recent momentum you'll see is positive. On a quarterly basis, Q3 was a record quarter over the last 5 years for all deal flow around the world. Slightly skewed in terms of the size of deal. So the deal count is down, which means larger deals are getting done, but it's still good. I've been thinking about M&A since I joined the banks in 2000, and there's an inverse correlation between interest rates and deal volumes, and we're beginning to see that play through, which is positive. And hopefully, as we get into next year, that'll yield results for the lower middle market as well as the sort of the large mega deals. Looking forward, I thought this was probably the most interesting piece I could find on my travels. Goldman is betting on a bumper year, and it's not just Goldman. JP Morgan and some other banks are betting that their M&A departments are going to have a significant uptake on deal flow next year. The couple of reasons why they talk about this concept that change creates M&A. Pointing to historical patterns where major disruptive events trigger big increases in deal making. And they put a figure of 30% growth on that. So that's quite bullish, obviously, 30% on this year's M&A volumes. But there's only so long M&A can be held back, if you will, as CEOs and boards hopefully gain more confidence as interest rates come down. They'll start to pull the trigger on more deal flow and not just rely on organic growth, or they might frankly be under pressure to do inorganic activity. So if interest rates keep coming down and there's no major surprises on the political or geopolitical front, hopefully then we see a much better year for M&A. That's obviously important. That's key. That's key context for ultimately getting to brand valuations, which we'll come on to. So let's jump into e-commerce trends then, and I'll ask Max to take the lead here.
Thank you so much, Emmett, for the introduction. It's always a pleasure to speak at the webinar, and there's always something new that I can learn as well, so very much appreciated. Let's start away with preparing for the holidays. So if we go to the next slide, thank you. We see that we are now closing into Black Friday week next week. And so far, the US e-commerce compared year over year is more or less on par. So it's lagging slightly behind. We're comparing here the data from the start of October until yesterday. And it is sort of on par, but we don't see a stark increase or strong increase in ad spend yet. So we expect this to take up a bit more as soon as e-commerce companies start to increase the advertising spend. But so far, it seems like the rest of the year in e-commerce that we don't see a huge amount of growth compared year over year. We go to the next slide. We do the same analysis for the two biggest e-commerce markets in Europe. In the UK, we actually see a strong increase in growth with 7.8% year over year, which is not that bad. But in comparison here, we also see that the e-commerce companies in the UK have already started to increase their ad spend quite strongly as compared to the year before. So we might just see the ad effectiveness taking place here. We go to the next slide. We see in Germany, we actually have a 3.4% decrease compared to the year-over-year. But again, similar to the US, we don't see a large increase in ad spend yet. So we are hoping to see some more growth as soon as that really starts to kick off by the start of the next week. This is sort of the update to the current state. And now Emmett has already given a great introduction for change that is coming to the industry as a whole. And we wanted to be at the forefront of analyzing this change. So we opted to create a study. And what we tried to find out is what is the truth behind all of these headlines that I'm sure all of you guys have read online. So there is a new development from the LLM companies, AI companies, to find new revenue streams. And these, of course, include e-commerce. So OpenAI has now started to partner with Etsy and Shopify to provide direct checkout systems within ChatGPT. So the idea is that you are now going to use ChatGPT instead of Google to find the products you want to buy. Amazon has reacted quite dramatically against this and is suing Perplexity for scraping their products. Because of course, Amazon still wants to own the customers and not give this ownership away to the ChatGPTs of this world. So there's a lot of things happening, a lot of panic, I would say, a little bit. And we created this study to see what the actual facts are at the moment, because there's not a lot of real data points available. Next slide, please. And what we did for this is we took a subsample of Grip's data, which is around 1,000 retailers from across the world. This data set covered around $20 billion in revenue in the last 2 years. We see around 160 million transactions, with 50,000 transactions coming from ChatGPT. So this is the first study of real data. And what we see here is that, first of all, this is the left-hand graph. ChatGPT is by far sending the most customers to e-commerce websites. So what we look at here is last click attribution, which is not a perfect way to track this, but the best we have available on this scale. And all the other chat platforms, LLM platforms, we can basically omit them because ChatGPT is by far the biggest. On the right-hand side, though, you can see the share of the total traffic coming to e-commerce websites. And this is on a log scale. So each line up is 10x. And the red line down there, we denoted them here as organic LLM traffic, is from ChatGPT. And yes, it's increasing strongly, but Google search is still 200 times larger than ChatGPT. So if ChatGPT wants to become the Google killer that we have read online in a bunch of articles, it has two options. Either it becomes larger or it becomes more performative. And we'll look at this on the next slide. And here we compare the conversion rates that we see coming from the different channels that we analyzed on the 1,000 e-commerce websites in this study. And on the left-hand side, you can see the average conversion rate we see from these channels. And you see that for most other channels, this is quite stable. I mean, Google search has been around forever, so there's no real trajectory of the conversion rate anymore. What we do see is the red line with ChatGPT traffic is that it's ever increasing and always getting better. So this change that Emmett was alluding to is definitely going to come. ChatGPT is increasing, but not in a way that it's completely eclipsing Google. What we see on the right-hand side, we all don't have a crystal ball, but we tried to give some intuition here. We created 4 different prediction scenarios on how ChatGPT is going to develop in regards to the conversion rate, which is of course linked to the revenue it's going to drive. And we see there that it's going to likely be on par with Google within the next year, maybe also with a higher volume in traffic overall. And on the left bottom side, we probably have the prediction that OpenAI would put into their quarterly reports with a dramatic increase for conversion rates for ChatGPT. So these are the findings that we had. So overall, the year so far, not extremely great for e-commerce, but we're still positive here. And next year, we're going to see a lot of more disruption from the LLM-based e-commerce. If you go to the next slide, I think that should be the thank you note. If you have any more questions regarding this, happy to go into the Q&A. Thank you, Emmett.
Yeah, thank you, Max. Yeah, questions from Max, please submit via the Q&A button. Appreciate your insights as always. Love the data-driven approach. So thank you, Max and Grips. Okay, so let's then think about the public market comps. Where are we in terms of listed companies and their performance? Let's move to Austin, please.
Hey, Emmett, great to be with you guys as always. Just for background, so people understand the data set that we're looking at, we've been tracking a basket of public securities since 2021 that we perceive to be sort of the group of companies that best represent primarily the direct-to-consumer business model, although we'll have some notes about hybrid and omni-channel businesses. You can see the logos here that we track. And if you go to the next slide, we've actually decided to add 4 new names to the basket here based on their recent performance and some IPOs. So the first one here is On Running. They make sneakers and have done really well and have enough D2C in the mix to qualify for us. Birkenstock, another one, a legacy brand that's got some new blood and is coming online, just went public. Restoration Hardware has been there as well for a while, luxury furniture brand. We've decided to include them, and Deckers Brands, which owns UGG, Teva, Hoka shoes, another footwear brand with a significant direct-to-consumer footprint. So those are 4 new names in the index. They didn't dramatically sway the longitudinal data, but they do have some impact on how we look at the index overall. From a top-line perspective, just the snapshot of where we are today. Again, focusing on that line, the median line, which you can see highlighted there. The median company in this data set, about $600 million in trailing revenue. A wide dispersion of revenue growth, but the median sitting at 1%. Significant D2C presence. And importantly, you can see the valuation numbers over on the right. These are what we've tracked longitudinally. The median sitting at just under 1x EV to sales, which is interesting. That's really the first time in a couple of years that we've seen that dramatically drop below 1x, and about 10x EBIT to sales, which is actually on the higher end of the historical range that we've been tracking over the last 3 to 4 years. So we'll get into the mix of this a little bit more as we go here. A couple of big insights for us to kind of pull out, and I think this is belies some of that median data being super useful for brands. The first insight here is that the quality spread between companies has never been higher. So the dispersion of valuations between companies in this index is at an all-time high. So you can clearly see on this chart on the y-axis here, we're looking at the EV to sales multiples. That's essentially valuation. So higher on the chart means higher valuation. And we're looking at this on a margin basis over the last 12 months. So just in general, you can kind of see the spread between the top of the chart and the bottom of the chart is pretty wide. You know, companies as low as 0.2x sales, companies as high in the case of Hims and On and others, well above 3x sales multiple. Interestingly, you can sort of see that EBITDA margin on the x-axis is not necessarily a giant driver of that gap. So if you look at something like Hims, for instance, in that top corner, right, somewhere in that the 5 to 10% EBITDA range, Warby, Figs, Goose, if you just sort of read straight down the chart, right, have about the same margins and radically different valuations, which is definitely interesting. And so if you go to the next slide, we actually plot this against growth, so trailing 12 months revenue growth, and you can see a much more even dispersion and a much more linear correlation. So the premium for the most part for these companies is coming from their growth profile, not necessarily from their profitability profile in terms of where valuation is. But again, it's quite scattershot. There's not sort of an even distribution or a grouping of these companies. There's sort of 3 buckets, the mid performers, these sort of clear outperformers, and then the laggards in the group. So again, a large spread here. So I think from a valuation perspective, that points to the importance of really understanding the internals of these companies and not just blindly applying market comps. So to dig into sort of like what's really driving that as well, if we flip to the next slide, this is probably one of the most interesting insights in adding these new companies and doing a little bit more analysis on the overall business model of these companies and what's driving valuation. So just for some definitions, we sort of cut these into 2 main buckets. One is sort of the more pure play D2C brands, more than 80% of their revenue coming from direct to consumer. That represents about 60% of the index. This counts both online direct to consumer and owned retail direct to consumer. So Hims would be sort of the pure online version of this. If you look at something like Lulu, pretty even split, but lots of owned stores. Warby Parker, Allbirds, Oddity, and Figs, other notable names in that list. You can see the margin profile. And then interestingly, definitely a wide dispersion of valuations. So you have something like Hims, which is doing really, really well. And then you have something like Allbirds, which has the same pure play business model, which is really struggling from both a valuation and a growth perspective. So there's the D2C bucket. And then this omni or hybrid omni bucket, we're saying, that's actually the incorrect definition there. I can edit that, but it's a broader mix between the two. The hybrid companies, we are looking at, sorry, let me just give you the correct definitions here. 40 to 80% direct to consumer revenue. Interestingly, only a much higher degree of profitability in this channel. So the sort of core examples here are Decker, On, Birkenstock, et cetera, are doing well. Yeti and Crocs also in this bucket. I'll get into some of the metrics comparison in a second, but probably a super interesting piece is the degree and the consistency of profitability for these hybrid models. So if you go to the next slide, we've got sort of a more direct comparison just to look at it, and we can really see that premium is real. So this first column is the pure D2C bucket. The next column is the hybrid, and then you can see the spread here. A couple of interesting things to point out. Growth is different, but not materially different in terms of the median growth profile of these brands. A couple of things that we see is they tend to be larger. In other words, the revenue base on average is about 4 times larger. The EBITDA margin tends to be significantly higher, so plus 14 percentage points, which is very interesting given that sort of a lot of the historical conventional wisdom around direct to consumer was you can build a higher margin business by cutting out the middleman. At scale, at least, that seems to not necessarily hold true. The median EV to sales valuation multiple, again, about a 2/3 premium there, trading on an average of 1.5x to sales as opposed to just under 1x. The market cap higher, and probably the most interesting thing in this analysis is, much more likely to be profitable. So why is that? If we go to the next slide, a couple of the underlying drivers and looking at it, the number one piece is the customer acquisition model. CAC has continued to trend up and be a source of margin headwinds on the pure play D2C businesses, even the ones that are doing well. If you go look at the internals for Hims, for example, or On, they're continuing to see rising CAC. They're basically combating that by selling more services and getting more revenue per customer, but there's no relenting on the customer acquisition pressure. Whereas the hybrid companies have a couple of different ways to sort of soften that blow across the business model. The second big difference is just the operating leverage. So while there may be margin challenges across the wholesale business or going through retailers, the scale tends to be larger, and you can achieve additional scale in large chunks. So there's a little bit more operating leverage in that business model as you can spread out those costs over a larger revenue base. And then the third piece is capital efficiency. So you see this in the working capital models. Interestingly, what we see in companies that are in the mid-market or sort of small enterprise that are scaling is that there tends to be actually a tailwind, or excuse me, a headwind on the working capital cycle when you're first entering wholesale. But as you approach scale, you can start to get a tailwind on that because you're getting more higher dollar cash POs that can start to be used for marketing spend on the direct channel, for example. So anyways, a very interesting sort of dichotomy that we're seeing there with the omni-channel model really starting to win. The D2C game is sort of a game of winners and losers. There are strong outliers from a valuation perspective and a lot of losers there. But the hybrid model seems to be doing really well. There may be one more slide here, or I think that might be the end. Oh, some private company benchmarks. So this is the DryPoint internal benchmarks. I just thought it would be interesting to share with the audience. These are our September 2025 benchmarks across the board. Just some notes on margin, contribution, profit, and EBITDA margin. Interesting. Net revenue margin median is about 90%. Gross profit margin we're seeing at 66%. That's product margin, doesn't include the variable costs. Contribution margin sitting at 40% on the median, up to 63% on the other side. And then the EBITDA margin, again, that number can't be right. I will fix that up for you and get you the median number there. But those are the latest private comps from our data set on the EBITDA margins, or on the margins from these companies. The median there is 5.9% on EBITDA margin there, Paul or Emmett.
Great. Thank you, Austin. I'll keep that live so we have it done. Excellent. Thank you for your insights. Great to see some more companies being added to broaden your data set as well. Questions for Austin, please submit them in the Q&A tab, and we'll get to those at the end of the webinar. Okay, so let's look at M&A activity. Invite Joshua back to the floor, please.
Thanks, Emmett. Yeah, so just really trying to take a look at, the nature of trends and how important it is to be building, a really strong operational business today to seek investment, to seek exit. If we go into the next slide, just by way of quick background, for the entirety of my career, I've sat at the edge of emerging industries, social media marketing, social commerce, D2C, e-commerce, challenging biotech, and emerging technologies. Ultimately, I've always been driving strategy for some of the world's biggest brands. If we drop onto the next slide, as we discussed at the top of the session, we are an investor and operating partner. We have over 30 top decile operators in our business. We invest, but we're also sort of in the trenches with management teams. And just to reflect some of that, our portfolio currently consists of 4 assets. Current Body is probably the most notable, which recently IPO'd at a valuation of over £300 million, and that was eComplete's first investment back in 2021. Just give some context to our background and the things that we've seen, I guess, whilst going on that journey. If we jump forward, got a few key points to cover today. Going to be taking a look at our perspective, some of the metrics that we think matter, what investors might be looking for, what we look for, and then also just a little bit on the deal space. So just to sort of zoom out, we believe that funding, hasn't disappeared. We do know that deal count is extremely low at the moment. We think that, there are record amounts of dry powder, and we actually think that the big challenge now is conviction and investors being able to tell apart winners from noise. And so we think that great operators stand out today, and we think that they are, they've got an unbelievable advantage in front of them. If we hop on, just looking at some of the deals that are happening, we know there are major brands that are transacting and being acquired at the moment. Dr. Squatch, Medik8, Rode, there are some particularly huge checks being written for some of these businesses, and quite interesting points and characteristics that set each of these apart. Moving forward, if we take a look, we're just going to spotlight Rode as one particular example. As part of Elf's acquisition of Rode, they've released the P&L that sits behind Rode, and some incredible metrics that we think are really stand out. The business was acquired for $1 billion. If you take a look at some of the operational points, COGS at 19% and a GP operating at 81% is just phenomenal. If you think about cost of delivery, this business is backed up by, yes, celebrity power, but it also had the combination of operational excellence behind it as well. And I think just going back to some of the metrics mentioned in the previous session, thinking about EBITDA, a 34% EBITDA is something that most operators and founders dream about. But really being able to look at the scrutiny placed on marketing efficiency is something that's quite interesting when you analyze Elf's acquisition of Rode. Just jumping forward, I think, again, looking at some of the challenges in scaling businesses, there's a really nice sort of snippet that came from Gavin Gevender at KPMG. International, geographic diversification of sales channels, supply chain, all of these things are really quite integral to growth. If you think about the scale of some of the businesses that have been well acquired, they're either primed for international expansion, and that's where a lot of the next leg of the journey is coming in, or they're already established in a lot of key territories. And so international seems to be the big lever for a lot of businesses that are trying to grow and scale in the current landscape. And ultimately, that's what's going to set up a business for success. And I think finally, just to sort of round out this session, I think one thing that is on the next slide is probably most pertinent is that, you know, there are real headwinds against founding teams, against management teams, from channel mix and scrutiny over marketing, and placing real challenge on customer acquisition costs, which are continuously scaling and rising, to being able to really pin down supply chain and make sure that you aren't leaking value. Understanding data and being able to really read into that to set your business apart and help drive things forward. And of course, having an increased amount of competition, probably more competition than ever. Really, if you think about some of the knock-on effects of what a business's makeup could ultimately lead to, if there's dependence on a single channel, there could be an implication to valuation. If you think about rising COGS and supply chain volatility, there's a margin pressure which prevents scale. Poor data visibility can ultimately lead to poor integrity and then a trust gap, especially if you're dealing with investors and planning to exit. And then obviously more competition means that there are more potentially better opportunities out there. So a really challenging time as it relates to trying to get through and achieve an exit. But we think that, you know, the nature of what a great business looks like is changing on that basis. And there's never been a more important time to scrutinize cost base and really think about alternative means of scale. You know, and a key takeaway, we think international is really a key part of that. So really a quick snapshot there, and we'll come back and join you guys in a moment just to talk about some of the metrics that we look at that we think are important.
Thank you, Joshua. And just to slightly break Joshua's flow for a second to do an advert from the Fortia group, we wanted to sort of show the importance of preparing for an exit as soon as possible, you know, far in advance of when you actually want to pull the trigger. We call this step exit ready, and that's ultimately where we, and I'm sure the guys at eComplete, think that the businesses can create the most value for when they ultimately go to a sale. To me, when I did big deals at the big investment banks, there was this process that we followed. We're engaged in the same process here at the Fortia group, and really, like on the back of the envelope, think of it as just a flirt, date, marry. So rather than, you can't just go straight to marriage in 6 months or 9 months. It's very, very unusual. Typically, strong marriages can take, you know, 1, 2, 3 years to form. And so we encourage all our clients to start to flirt and to date way in advance of the deal. And so what do we mean by that? Ultimately, the key part in that is speaking to acquirers far in advance of actually doing the deal. So you don't have to mention all sensitive or confidential information, but start flirting. Tell strategics, private equity firms, selected targets about what you're going to bring to market in due course. Ask them the tough questions. Say, if you were CEO of this business, what would you do differently to ultimately yield a better exit? Ask them key strategic questions. Should we launch in this geography? Should we think about this new product? Should we go omni-channel? If so, which channels? Start to make the business as viable as possible. The best laid plans only survive contact until you meet the enemy. So we embrace actually chatting with the enemy early on in the process. So you make the business more viable, and it also gives you the option of getting bought, not sold. If a company thinks that you're going to come to market in January with the Fortia group, you may well get an offer to be taken off the market in advance of that. So if you want to do a thoughtful, longer term preparation process to an exit, please reach out to one of us at the Fortia group. Joshua, back to you on brand metrics, please.
Thanks, Emmett. And I think a really strong point that's made. And so just when thinking about, you know, metrics and that side of things, we probably start by trying to call out, you know, typical diligence. We don't think it necessarily works for modern D2C brands. And I think that this is probably an ideology shared between ourselves and the Fortia group. But ultimately, old traditional models are typically a little bit stale. They will focus on, you know, a historic view of performance, and they'll ultimately aim to avoid as much risk as possible. There's a heavy sort of legal sort of focus that comes within those processes. And actually, eComplete, we've rebuilt commercial due diligence and the way that we look at data to make sure that it's driven by an operator's perspective. So that's a growth plan that's grounded in experience and knowing what levers to pull, being able to look at a 3-year roadmap that can be delivered with success and resourcing that correctly, and having a commercial focus, focusing on the right KPIs that ultimately then positively impact the P&L and financial performance, but also being able to find ways to get more comfortable with risk and being able to look at the risk reward possibility that comes out of a deal. A big reason for us exploring an alternative to commercial due diligence was to give us more actionable data. We believe we probably have 50% more actionable data than a traditional commercial due diligence process. We can spot issues early, and we can make sure that we help deals continue and can continue with momentum and be successful, which ultimately leads to a more efficient deal process. And finally, as we go through a commercial due diligence process, we're able to track and monitor performance in real time, have conversations with management teams, and really make sure that you can drive things forward. And I think that exit readiness piece, you know, a great complement to that is making sure that you have a real tangible view and visibility on data and the things that you can act upon and move. And onto the next slide, there's a really great example of this, which is with Current Body. And so Current Body, first investment mentioned before, has recently achieved a successful IPO at £300 million valuation. Quite an interesting story. The business came to the end of a failed sales process, and investors looked at this business seeing a low repeat rate and a high price point. They weren't convinced that that was a scalable proposition. And actually the recommendation from a lot of advisors at the time was to diversify and broaden the third-party model. At the time, third-party revenue was about 75% of the revenue mix. And actually off the back of our commercial due diligence, we were able to get comfortable with turning off 75% of Current Body's revenue to focus on first-party own brand. And so if you think about the journey for this business, it was doing 30 million back in 2021. Today's achieving over 100 million in revenue. Actually, at the time in 2021, it's probably about 16 million in own brand revenue. So if you think about the scale from 16 million in own brand revenue to over 100 million, it's quite some journey. And ultimately the angle was to take Current Body and create a market leader and really push that on and become a global market leader. And we can successfully say that there's been a great return for investors that followed us on that journey as well. Onto the next slide. So a point of difference in the way that we maybe think about and look at businesses. We've built an investor attractiveness scorecard that we use to essentially tell us if we think there is a good business in front of us with opportunity to invest in scale. And it's the first step in our journey. And if anybody is considering an exit or interested in understanding how their business performs, please do reach out. But we're looking at a range of metrics here. We're looking at some of the typical finance metrics that you would expect. But we're also taking a look at growth performance, understanding how the business sits in terms of current trajectory. Is it flat? Is it progressing? We're also looking at team experience. We're looking at risk and compliance factors that may prevent a deal from moving forward. Is there in-house manufacturing or all third party? We're obviously looking at customer health. We're trying to understand at a granular level the performance of acquisition, the performance of retention. But interestingly, one of the big levers for us is also international capability. What does the business look like today in terms of international revenue? Is it a business that can scale internationally quite easily? Is the ability to go cross-border and actually fully expand into multiple territories? And some of the questions that we'll ask as we're looking at a business and trying to give our sort of perspective and validate investment potential is, you know, can this business be internationalized? Why hasn't it been internationalized already? What are the barriers in place preventing the current team and business from doing so? And then in addition to that, what shape does the business need to be if we're to achieve a successful exit? Talking back to that low deal count, we think the nature of the way that PE and larger sort of large to mid-market investors are looking at businesses is quite different. It's not enough to take on a beauty asset, scale it, sell it. We think that there needs to be more unique approaches to business structures to be able to warrant an exit. Onto the next slide. You know, if you are looking at translating this into KPIs and thinking about things that really do help to build investor confidence, obviously you have a lot of typical metrics that you think would be important and pertinent, and they definitely are. You know, LTV to CAC, understanding across a business, thinking about contribution post-marketing and the scalability of a business after advertising, looking at some more specific metrics as it relates to retention, but also being able to measure marketing efficiency ratio, which we saw a great example of with Rode at that 9 times. And I think investors, if they're looking at these metrics, they're trying to understand, can the brand scale without breaking its current business model? Do unit economics work in its favor? Other situations, if you have a business that's heavily dependent on paid channels, what if those channels go dark for 6 months? Can the business sustain performance? Can it continue to grow? And then additionally, what's the 100-day plan to create value post-deal? Part of our business model aims to think about that in commercial due diligence, and a big lever for us is group procurement and giving economies of scales to our brands so that we can immediately come in and realize enterprise value. And a great example of that is our most recent acquisition. Having analyzed supply chain and current sort of operational rates that were in place, we were able to optimize that and deliver an extra $500,000 to EBITDA within the first 30 days of owning the business, which is a great story to be able to tell to investors and is a great signal of success. And so finally, just to sort of summarize things, the key takeaways on the next slide. We think some really important points to focus on. We think GP is more important than ever. We think typically a great asset probably starts with an 8, and you saw that with Rode. We think that businesses should be scrutinizing fulfillment and operational costs and doing everything they can to drive efficiency there, to bring back additional capital to be able to scale. We know that acquisition needs to be profitable, and to what degree can we get comfortable with acquisition not being profitable if it has great retention performance is something to consider. And so retention naturally is still a big part of investable businesses. And finally, international capability and potential is going to be the biggest thing that will impact growth for a business. So a few key highlights just to round it out and maybe sort of bring a view on some of those metrics and areas of focus.
Fantastic. And the speakers today are already answering questions on the Q&A tab. So please submit questions, and the speakers will type those questions, and we'll come to them live at the end of the webinar. Thank you, Joshua. Okay, so now we'll move on to deal dynamics. Before we talk about valuation, we'll have Paul discuss some of the recent deals he's done.
Hi. So yeah, I think like in the headlines a little bit is current body, so I'll cover that a little bit. We made the investment just over 4 years ago now, but when we IPO'd it was 3 years and 11 months. It was 36 million of revenue, making 3 EBITDA, and fortunately we've been on a really good journey with it. We identified it as a UK leader, and the own brand element of the business being a UK leader, and we helped that business globalize. Well north of 100 million now. We just actually put a trading date update out, which is pretty good because I have to be careful about what I say now that it's on the LSE. But yeah, we just put a positive trading update out, which is nice. Guidance for this year is 32 million. So again, we're kind of 10 times EBITDA in that period. Why didn't we sell it to private equity was a question that we got quite a lot. And we had a few conversations, but basically we found that private equity was just paused really, especially for consumer and D2C businesses. And we also found that because there wasn't many businesses that looked like it that had gone before it, then it was quite hard for private equity to get their head around it, which is really insightful to us because it tells us really the decision wasn't made on anything to do with the business. It was all these macro events, if you like. So that's definitely a position where we stand out. We went down the IPO route, just basically the commercial of, are you going to find one PE house to pay 300 million pounds for it, which we thought was the fair price, or are you more likely to be able to sell a third of the business and find 20, 30 people to put in, a range between 2 and 8 million. So it was more obvious, more commercial, straightforward decision, actually. I always say it's a harder decision for the management because they go on and live in a completely different world. So, they had to be very comfortable with it. But thankfully they were up for the challenge and we got the listing away at bang on 300. So it was a really good experience, and a really good result. And actually we're very happy that we've rolled effectively 70% of that business because we believe in the momentum of it. So yeah, that's a quick headline on that deal. It was over a 5x for our investors. So, and again, that's on paper because people have only liquidated a third of the stake, or 30% of the stake even. But again, a really good result for us. And we've just completed a deal pretty much in the same month, actually, which was never the plan, but we just did our latest deal, which is a D2C brand, 100% D2C, 100% UK. It's in the fragrance space, and yeah, like circa 30 million valuation. We've got we think is a really attractive multiple on that, which is below the averages. So yeah, look, we're active in the market. I think what I'd probably throw in, I don't know, Emmett, if you wanted to steer me in any direction or just let me loose a little bit.
Go loose, Joshua. Free blank canvas. Yeah.
And remember, it's Paul. I've stolen Joshua's link.
Sorry, you got me.
Joshua's on twice.
Yeah.
Sorry for confusing everyone though. So yeah, I think the way, this is always really interesting. We did one of these a while ago, Emmett. I joined you. So they're always really interesting. You hear a lot of noise about the PE market, or just global deals being back. And obviously some of the information shared today's highlighted that. I think what Austin was sharing in the dispersion that you see is really interesting. Because we've got a much narrower lens. So we just look at beauty. So we'll buy in beauty and we'll buy in nutrition, and we say we're category agnostic. So we do look at other things. And I'm sure we will do deals in categories that are outside of beauty and are outside of nutrition, but that is definitely our home where we are comfortable. And when you look at deals in the US, there's like 120 deals that happen a year in beauty in our size of deal. So anywhere between a 25 and a 50 million valuation. So there's actually not a lot of deals that happen. If you go to Europe, there's kind of, I think just over 100. UK is about 25% of that. And then when you put all those numbers into PE deals, and that's it's the space we usually compete in, about 40% of those deals happen in PE. So when you look, boil all that down, you're talking about 10 to 15 deals that happen a year in beauty, in that space of beauty at 25 to 15 mil. So we're looking at a very narrow lens. So we can get a little bit more specific. And in terms of deal dynamics, what are we seeing? We're seeing that valuations continue to drop. From last year to this year, average valuation in beauty deals is just around 6.5 times, dropped 0.5% from the year before. So there's more deals aren't getting done. The number of deals year on year is quite steady. Valuations are still dropping, which tells us a few things. Really, there's no confidence in consumer still, and especially in D2C, there's even less confidence. So it's a really good time to be acquiring brands, if you aren't relying on making your decisions based on macro environments, and we never are. We look at the data points, as Josh said, that matter to that business. I know I always say we've never grown a business, that in my time, in line with the market. So we will never use market growth as an indicator for ourselves. But there's a small number of deals that are happening. What do we know about those deals? And one of the specific directions you kind of sent us in, Emmett, was deal structures, asking that question. So deal structures, we're seeing that earnouts are becoming less frequent. So 2024, you saw about 15% of transactions having earnouts. That's dropped to 10% this year. I think there's a correlation with as prices get lower, multiples get lower, sellers are less prepared to kind of have the added complexity and risk of an earnout. What is interesting, and we've not done any deals like this yet, but it is interesting to us, and we may well do, is seller notes. So effectively, these are the kind of still, it's the right word, the supporting valuations, really, as well. So what that means is actually valuations would be coming down less, or valuations without seller note mechanism are actually lower by another half a turn. So you then into the top, the 5.8 times multiples for deals that have happened in the last 12 months that haven't had seller notes. So seller notes are when the full funding isn't delivered. The seller will take a portion of the payday in future years with an interest rate. So they will typically give up 25% of the equity value on day one. And as long as performance maintains, they get that earnout for following 5 years with a 10% interest on it. So that's a really interesting dynamic that came from the US. That's becoming a little bit more popular in Europe and the UK. We've not done a deal with that mechanism yet. But it is certainly an interesting mechanism. But I think the important part of that really is that that is underpinning valuations. So actually valuations are lower. And I think that's a message that doesn't really get into the market. People still try and come, and seek 10 times multiple, for a business that's slowed down and yeah, and I think there's too much I wouldn't say bad advice, but too many people tempting to people to come and do deals with valuations that are a little bit unrealistic, and it means that people go and take 6 to 9 months of having a failed process and come back at a more realistic price. And deals are just generally taking longer and more expensive.
Very good. Thank you, Paul, for that. Any questions for Paul, please shoot them via the Q&A button. Okay, so all of those 6 components that we've discussed, from global M&A through to e-commerce trends to brand dynamics, etc., deal dynamics, all impact valuations. So just to recap, you can see the 6 points that we've gone through on the left, from global M&A down to deal dynamics. We score them every few months. December 2021 was the high. You'll remember on one of the earlier slides, that's when we saw the most deal flow, the highest valuations. It was a perfect storm, particularly for e-commerce. So our score was 60 out of 60, and that led to like crazy multiples. And some of the multiples would be even beyond, not for FBA-led brands, but for DTC-led brands, that would have been higher than on the chart there. If we roll forward then, July of 2024, last year we thought was the low, the lowest of the low. Our score was 19 out of 60. We at the start of 2024, we had hoped that interest rates would start declining in sort of May, June, but that got delayed. And so it was pretty tough time in e-commerce M&A back in July 2024, but it got worse, unfortunately. The good news is it's getting better. Bear with me. Q2 this year was the worst quarter in history in e-commerce M&A from my perspective, given the trauma from tariffs. Most acquirers didn't want to pull the trigger in Q2 on deals before they understood the consequences of what Trump was up to from a tariff perspective. So it was pretty gloomy a few months back. Thankfully, based on everything you've seen and heard in today's webinar, things are getting slightly better, and we can be more optimistic for next year. So you'll see on global M&A activity, we've increased it to 6 out of 10. If those forecasts that we saw from Goldman and others actually deliver, then I think we can get towards 8 in Q1, which would be great. E-commerce trends broadly flatlining. You saw from Grips, public market comps, EV to revenue is down, but EV to EBITDA is really good. So actually, maybe on reflection, that should be a 5 or 6 today. E-commerce M&A activity, deal volume is still low, unfortunately. There's been some great deals we've discussed on this call, but the volume of deals isn't there yet. Hopefully that'll come back next year. Brand metrics is still relatively low. Deal dynamics, I think, will start to increase as we see more players come back to the market. So overall, that means we're at a 21 out of 60 score point as of today. That number will go up when we do our next webinar. I expect it to be up significantly. What does it mean? So on the left, we give our range for FBA-led brands. On the right, we give our range for DTC Shopify-led brands. So what we're saying is, let's just talk about FBA for the moment. Growing and profitable brands are trading between 1.5 and 3 times. For diamonds that are sort of the perfect storm, it can be up to 5 times. On the DTC side, distressed are up to 2. Most growing and profitable brands we see are somewhere between 2 and 6. I appreciate that's quite a wide range, but we see all sorts. There are always exceptions on the upside. There are brands, that getting done way above 6 and up into the teens. They are absolutely the diamonds. They're few and far between, but it is possible if you prep really well, if you gear up and have great metrics along the lines of what Fortia has shown, what eComplete has shown today. So there are the ranges today. I think for beauty, Paul was saying 6.5 or 6-ish, 6.5. So and I guess they're more for sort of really good brand stroke diamonds. So that's where we are. So do we have any time left? We've got 2 minutes for questions. Maybe if I jump to the questions that are in the chat, we can answer some of these live. Any perspective on FBA multiples? Yes, just shown that. Let's see. There was a question there about the impact of recurring revenue on DTC valuations. Myself, Austin, and Joshua have given their thoughts. Paul, do you want to give your thoughts on that? How important is recurring revenue for DTC valuations?
Yeah, it definitely puts it in a higher quality of an asset. And it really depends on what that payback period is still, though, and the churn. But there's a really strong business that we're looking at the moment that's got a 8% subscription, profitable on the month 3. So yeah, I do think that really does enhance multiples, and if you're paying 5 for a business without them, you could well be paying 7, with really strong subscription revenue.
Very good. Maybe just to finish, I ask each of you for sort of one key takeaway you give to entrepreneurs thinking about gearing up for an exit. Who'd like to start? Maybe if we go Max first, and go in order of the slide.
Not a lot of time to think, unfortunately, but seeing the feedback I got, looking into new forms of making profit off your e-commerce companies through new channels that are developing is definitely going to be a key part in the next 2 years. And being a viable business in a changing landscape, probably going to be more valuable.
Thank you, Max. Austin?
Yeah, my primary point of advice, and I share this with a lot of companies in our portfolio who are going out to raise capital, is don't necessarily rely on the investors that you're talking to have the best grip on your data. You need to be driving the bus as far as your metrics, how they're defined, what the definitions are, et cetera, because there are highly varying degrees of both expertise and facility with the data on the investor side. And so that preparation and essentially having your data room, and to an extent possible, a platform that is, ready to go and readily accessible by investors with data that matches how you look at the business and how your financials are presented, is mission critical and can save both time and ultimately be a key determinant in whether or not you get a deal done. So that data readiness piece, and Joshua, I think you did a nice job of articulating sort of old way, new way, is 100% real and can be the difference between a successful acquisition or not.
Yeah, fully agree. Thank you, Austin. Joshua?
Again, maybe build on that point. So understanding your data is definitely key, but looking at some of those external benchmarks and challenging your business, your team against that. If you look at Road, It's rare to see a P&L that looks like that, but what can you do to move the dial a couple of percentage points, scrutinize fulfillment, look at any operational efficiency you can drive, be armed with that as you speak to investors, and make sure you have a great value creation plan. I think they would be the key things that I would hit on. Yeah.
Very good. Thank you, Josh. Paul, to finish, please.
Yeah, just like keeping it really simple. It'd be product, unless you have got a product that's going to drive repeat rate and customer loyalty, then probably nothing else matters if you just have to pick one thing. Keeping it less simple, being ready for an AI first world. So we're moving from what has been social first for the last 5 years, and is it hitting the maturity cycle? It's already happened in China, where it's just very hard to make money in China. You know, it's too easy, be too commoditized. But being able to also be prepared for an AI world.
Very good. Great. Thank you, Max, Austin, Josh, and Paul. Appreciate your color, your thoughts today. And as a reminder, we'll send the recording and the deck to everyone that's attended today. And wish you all a super rest of your day. Thank you for joining. Take care.
Cheers all. Thank you.
Bye.
Thanks, Emmett.
Bye. Thank you.